This is Michael Brandenburg. I'm the Regional Vice President of the Midwest region, the Upper Midwest. And thanks for taking some time this morning to listen to some sales ideas here. We're going to talk about one main idea. I have a second one here if we have the time and want to go that direction. The main idea we wanted to talk about today, however, was the 10-10-10 sales idea. And it is an idea we've talked about for some time, but this sales idea is far better than anything we've talked about in a very, very long time. And the reason is it's easy to tell the story. It's easy for me to tell the story. It's easy for agents to tell the story to their clients. So that's what we're going to cover here. And believe me when I say we're going to have some extra time because it's really pretty straightforward. So at some point in time, Melissa will probably open it up for some questions, I have a feeling, right?
Right, yes, sir. Yep, at the end, we can
Excellent.
open it up.
Great, okay. So idea number one, 10-10-10. I don't know if we have any hunters on the line. I know Premier's located over in Norfolk, or as they pronounce it, Norfolk, Nebraska. And I know we have some hunters up there, and I love this tagline. Now, what if you could knock out 3 birds with 1 stone? Well, you know, the saying is kill 2 birds with 1 stone, right? Well, we increased that idea 50%, and we're saying, what if you could knock out 3 birds with 1 stone? But hunters don't knock out birds, right? Where I'm from, we just shoot them and we kill them and we eat them, right? That's what we do. I think this is funny. So anyway, so much for a joke there. So let's see how you can knock 3 birds with 1 stone, and that's the idea of the 10-10-10 plan. What if there was a way you could combine some permanent insurance, guarantees to age 100, and have chronic illness benefit all rolled into one? That's what the 10-10-10 plan is. It's extremely simple. Here's the basic idea. A client could pay their premiums for 10 years. The next 10 years, they're going to wait and not have to pay anything anymore. And then the third 10 years, they're actually going to get their money back so that, in effect, they have returned their premiums, kind of like a supplemental retirement benefit, and still have benefits left over. That's what the idea really goes into. So let's talk about the background a little bit. You know, term insurance definitely is the most popular form of term life insurance coverage, or just life insurance coverage in general. Why? Because it's inexpensive, right? It's cheap. That's what it's all about. However, if you need longer, more permanent needs, there's a lot of different directions that could go, and the most secure and economical generally is considered to be the Guaranteed Universal Life, or GUL as we call it. GUL is usually a stripped-down, no-frills policy, and doesn't offer really any other benefits other than your guaranteed death benefit for a period of time, generally to be age 100, age 121. So it's a long period of time. However, with our Secure Lifetime GUL3 product, we can add some pretty innovative extras, and really pretty much for the same price as what most other carriers are offering their GUL period. So let's look at our example here, and this will help you explain the 10-10-10. So we have a client, George is 50. He's looking for $1 million of coverage for his family. You know, he may be a small business owner and wants to make sure that, you know, maybe it's part of a buy-sell. It could be a lot of different scenarios, or it could just be he never got around to buying some forever coverage, and it was time to do that. So he's going to provide life insurance coverage for his spouse well into his retirement, right? But he sees that, you know, that in his later retirement years, he's really not going to need quite so much. You know, maybe he will have sold his business. Maybe, you know, the whole idea of income replacement, if you were later into your retirement, you know, you wouldn't need so much at that point in time. So the idea of decreasing it in later years kind of makes sense as well. But thirdly, a large concern of his is the impact of chronic illness on his retirement. You know, if someone who has had a long-term care event in the family, generally they really begin to understand how important it is to have chronic or long-term care coverage in later years. And you know, we have all kinds of statistics on that. You know, they say that upwards of 75% of senior adults have two or unable to do two activities of daily living, which would qualify them for chronic illness benefit. So very, very important. If your clients don't know about it, they need to know about it, because they need to know that the odds of something happening to them are extremely very high, definitely very high. So here's the 10-10-10, all right, is what it comes down to. The client is going to pay $24,000 for 10 years. Now, what that means is he's short paying his GUL contract. A lot of times people don't realize that they could pay it up in 10 years and be completely done with the idea. That's what George is doing here. So he pays it up in 10 years. He doesn't need to pay ever again. The next 10 years, he's not going to pay anything, right? So from 50 to 60, he pays $24,000 a year. The next 10, from 60 to 70, he doesn't need to pay anything. The next 10 years, from 70 to 80, he's going to take an income from his own policy, and it's a GUL policy. And he's going to be able to take it out tax-free because it is a return of his basis. Consequently, there's no taxes on it. So he bought a GUL policy. He's got this coverage. The GUL policy, not an overfunded IUL or a whole life contract or a VUL. This is GUL. But our GUL has the ability through the lifestyle income solution to produce an income. So the withdrawal then of the $24,000 for that third 10 years is actually going to reduce his own coverage, though, right? Because he's spending down his own death benefit with this longevity rider that we have on the contract. So that's the nuts and bolts of it. Pay for 10, wait for 10, and then create an income for 10 equal to what he originally actually paid out in premiums. So here's a little graph of what's happening with the death benefit. There he is at 50 with $1 million of coverage lasting for a full 20 years. It actually would go forever if he didn't want to take an income off of it. But at age 70, he decides, hey, you know, I'm gonna get my bases back out of this contract, you know, and actually use it for retirement income or whatever he chooses to. He reduces his death benefit down to $420,000 by age 80, because again, he's spending his own death benefit down at this point. And then from 80 all the way to 100, he has a reduced $420,000 death benefit, fully paid up, that will pay out at his death somewhere in between there. So that's how the life insurance benefit looks. At the same time, he had bought chronic illness benefit on this contract. So early on, during the early years, because his death benefit is what creates a pool of funds, he could have tapped into a monthly chronic illness benefit of up to $20,000 per month, depending upon a couple things there. But the point is, his pool of funds could have been $20,000 during those early years. At the point in time he starts spending down his own death benefit, he's spending his own pool of money. That means at the end of that period of time, starting at age 80, he still has a chronic illness benefit he can tap into through his death benefit equal to $8,400 per month during his retirement. And all that, by the way, is guaranteed. The one thing I didn't emphasize and need to probably several times here is that all these components in his contract are fully guaranteed. There's no moving parts here. What if of interest rates, if the economy does well, you know, anything else. The chronic illness benefit, the death benefit, his ability to get his premiums back out through our longevity rider are all fully guaranteed. All right, so the most important thing to realize is that, in fact, this whole idea is fully guaranteed. So again, he had the GUL benefit, he had a chronic illness benefit, and of course, with the longevity rider, the ability to produce an income later in life, simply because he wanted to turn it on. Again, he wouldn't have to spend it down, but that's one of his benefits. And in the sales idea, that's how we present it. Pay for 10, wait for 10, get an income for 10. And I submit to you that Americans like to feel like they get a good deal. They like value. And the idea of getting their money out of a financial instrument and then having something left over is a pretty easy position, easy sale to position. Because again, people like to feel like they do get their money back. So ladies on the other side there, Melissa, Kathy, whoever else is over there, at this point in time, do we want to take some questions on the 10-10-10 idea?
Sure, I've got one here. It says, why does coverage reduce to 420,000 if only 240,000 is taken out?
Excellent question. Let me go to that page right here. Okay, so the question was, why is it if George spent 240, it actually went down by quite a bit more than that? And the reason is that the longevity rider is designed to pay out a dollar for dollar spend down of your death benefit beginning at age 85. He could do this exact same idea at age 85, and he would be reducing the death benefit only $240,000 because at that point in time there's no actuarial discount. Because he's taking it before age 85, imagine when the actuaries designed this, that they said, you know what, average mortality is age 85. Why don't we just give people their money early? We're okay with that. On average, we're going to anyway. However, if they want to take their money early, most people wouldn't have died. There's a cost for that. So we're going to apply an actuarial discount. Therefore, the earlier somebody takes it, the more the discount. That's why instead of taking out 240, they actually took out what, 580,000 of death benefit to get. It consumed 580 to get 240. Whereas if George had waited to age 85, his death benefit would have gone down exactly 240,000, and he would have $760,000 of death benefit all the way to 100, right? I used a lot of words there to describe it. Does that make sense?
Yes, yes. I do have
okay.
another. Go ahead. I do have one more question, Michael.
Yes, please.
Let's see here. Would this be a plan for the example that you ran was for a 50-year-old? Would this be a good plan for somebody younger than 50?
So the question is in our sample, we've got a 50-year-old doing this. You know, would it work for somebody younger? The answer to that is, of course, someone younger could always do this as well. The thing about someone who's younger, and if they've got a long time horizon, is that time is on their side. And in a fully guaranteed plan like we're discussing here, everything's guaranteed, and guarantees cost something. So if you wanted to do a plan like this earlier, it actually falls into the idea that I have, which is a secondary idea, and I'm thinking maybe we should go back to it because this is the perfect example of it. For someone to buy guarantees at a very, very young age is going to cost them a lot of money. In my world, where I'm from, I often think that if someone has time on their side, they should maybe take advantage of a cash value product like an index universal life or a combination of these two ideas. So, ladies, if it's okay, shall I run through my other idea now? Because really that plays right into what I was thinking here. You know, we also I don't know if you can hear Bryant. Is Bryant on the line too?
I am here, Michael.
Yeah, Bryant. While I'm setting this up, do you want to kind of mention how maybe older ages, older than 50, also work?
Yeah, so as Michael was stating, in running these, to me, the sweet spot is probably 50 to age 60, maybe 65. That still gives you, if you're following the 10-10-10 idea, that kind of gets you the right in the right time frame. Older than 65, you'll essentially be pulling the income portion out at age 85 anyway. So, and one thing I don't know if Michael mentioned, but for the income rider, you have to have it in place, have to set the policy up at least by age 70, because the income rider has to be in force for 15 years before you can activate it. So again, sweet spot 50 to 60, maybe age 65.
Yeah, thanks, Brian. That's fair to say. So the maximum issue age that you could do something like this with the longevity rider is actually age 70, but really that's pretty amazing that even age 70 you could buy a GUL policy that produces an income at age 85, right? I think that's pretty outstanding. So what if someone's a little younger? And I think this sales idea really takes that into account here. So, do you want income, do you want guarantees, or what about both? So the background, again, is that there's a lot of uses for permanent insurance, and guarantees are great, but if you have cash value insurance, it could be tax advantaged and still have cash benefits. So here's the scenario, and this is going to bring index UL into the equation for someone who's a little bit younger. And by the way, the younger the better. The unfortunate thing is the very youngest people, of course, don't have extra cash laying around the house, generally speaking, because they're young, they're trying to buy homes, they're trying to send their kids to school, they're trying to save money, they're trying to do all those things all at the same time. But meet Grant. He's a 45-year-old pediatrician. He's married, 3 kids. He needs about $500,000 of coverage, right? Background, his investment suffered, so he's a little leery of the market today, but he knows he needs a lot of long-term coverage for a very long time, especially because his kids are so young as well. So he likes the idea of guarantees, but because a regular GUL really doesn't have any cash value potential, maybe his agent talked to him about something like an index UL, where now there's the opportunity for some cash value growth down the line. And, obviously fewer guarantees. So if he's got a budget for it, an IUL is a great idea because you can overfund it and turn it into an income down the road. So that's kind of the idea, is that when he's talking with his advisor, the advisor and him come to the agreement that they've got just shy of $10,000 extra per year to work with, and that's beyond whatever a retirement planning he's already doing. So idea one is just the good old-fashioned IUL idea of cash producing an income later in life. He's going to take that $9,700, he's going to put it into an index UL contract, our Max Accumulator Plus, and that would produce, and we're not going to go into the details of that, but that nearly $10,000 per year can turn into a 20-year income projected at current rates of $26,000 per year, completely income tax-free, because it's an income coming from a life insurance contract. So Grant's already kind of on board with this. Hey, here's another way to put money aside. It has death benefit with it should I predecease the plan. But at current interest rates, should the market more or less do what it's done in the last years, it could produce a pretty handsome income. And he's pretty happy with that. Of course, the coverage, ends when he spends all the cash down. So in an IUL contract, the idea is once you go through the spend down of the cash value, then the death benefit really is pretty much non-existent at that point. I mean, there'll be a small one, but it's not anything to send the kids through college at that point. Well, here's solution number 2, and this is a combination now. Now we're going to put the same dollars into 2 contracts instead of 1. So the same budget, still $9,700 per year that Grant was going to use, but now we're going to put roughly 2/3 of it into a smaller index UL, this time half the size, 250,000 max accumulator. And then we're going to put the other roughly 1/3 of the premiums into a GUL policy of 250,000. So instead of $500,000, we're going to go into 250,000. All right. Now, because that 250,000 took less cash, it can only throw off so much cash for income later, right? So now, unfortunately, he's only going to be able to throw off $19,000 per year for 20 years, starting at age 65 in retirement. However, in the two policy idea, it's kind of like the 10-10-10. He bought a GUL, and at age 85, that thing could also produce, using the longevity rider, an income of $19,000 per year from starting at age 86 for 10 years. And he'll actually spend down his entire GUL contract. So this is how it looks. If he's willing to take a trade-off, the trade-off of policy number one being more cash in the first 20 years, but then there's nothing left over, the variation then is that he could have an income of only $19,000 for those first 20 years with a smaller contract. But in the meantime, he's got a $250,000 GUL in the background, so he has a higher death benefit the entire time. And then, should he want to create an income starting at age 86, he can create a $19,000 a year income from his GUL policy, and in effect have a component of his plan be fully guaranteed, instead of a one policy plan that, of course, relies on a lot of projections and very little in the way of guarantees. So what he's been able to do is produce a little less income for the 20 years, for the first 20, but in the background, he's got a whole other policy fully guaranteed, and he can create an income from that in effect would net him more with two policies and has a part of his plan fully guaranteed. And yes, this slide's in here too. So this slide shows the guaranteed death benefit. And again, the blue lines being those first couple bars there, because you know, in the early years he's got a decent guarantee with the $500,000 contract and nothing else. However, once he goes down into spend down phase, the guarantees are almost nothing. Whereas the green lines here show the two policy solution, $500,000 IUL, $500,000 of our GUL. And you can see in the meantime, the GUL, of course, has a real strong death benefit all the way to age 85. The reason it's going down is he's spending it down. He wouldn't have to do that. But in his plan now, he has half of his plan being a guaranteed plan also. And then the bars are going down as he's going through the spend down phase. So Grant wanted a lot out of his insurance plans, right? So he got offered two solutions. He could maximize the potential for supplemental income in one contract, and one contract can have some guarantees in it. We have a contract that does also, but not in the way you can if you decided to go with a slightly lower income potential in the first 20 years, but with strong death benefit and income guarantees going all the way out from 86 to 95. So that's the idea. If you had someone who's younger, wants to take advantage of the time value of money, but still blend in this idea of having a component of your plan that's fully guaranteed, we found out that that's a pretty interesting way to put the two ideas together, so that there's guarantees and good cash value accumulations. That is a quick rundown of our two policy ideas. So let me just go back to this slide back here, if I can get it to go backwards quickly enough. Again, the same $500,000 coverage, just done slightly differently, right? So Melissa, Kathy, do we have any questions on any of this?
I do. I got a few coming in here. One of the questions was, and this was going over that the solution 2, is the $19,000 from 86 to 95 still tax-free?
That's an excellent question. So, quite honestly, what we're showing here, I don't know if it's the slide or the next one. Well, yeah, good enough. So here's the thing. When you actually spend down your own death benefit, right, death benefit was designed to go to usually the next generation, your beneficiary, and that's why the government allows it to be done completely income tax free. When you're spending it yourself, the same does not apply, right? So in our 10-10-10 idea, we withdrew our basis, so there was not a taxable event. In our idea number 2, where Grant's going to spend this thing down because that's part of his retirement plan, what we're showing is that 10% per year of that $250,000 or $250,000, right, would be $25,000 per year. What we end up showing is $19,000 per year, which is basically if he took out his money and paid taxes on it. To make it simple, we just called it $19,000 per year. But we gave him like a 30-some% tax bracket and said he's going to get $225,000 per year for 10 years until he spends his whole policy down. The reality is, through his basis in the policy, it wouldn't be taxed. Afterwards, then it would be. So that's why we didn't put $25,000 per year in that equation. We actually said, well, let's make it an after-tax number. The reality is the first several 3-4 years until he hits his basis would actually be tax-free. Then after that, it would not be. That's a very good question. That's a good distinction too, by the way. Good question.
I do have one, and this is going back to the first solution, or the 10-10 plan.
The 10-10-10? Mm-hmm.
Yes. They're asking if there's a way to use that type of a plan for an employer benefit.
A lot of life insurance can be used a lot of ways. I have not seen that done. Certainly you have some creative people on the line who are thinking, hey, this could be used a variety of different ways. And the answer is, you can be used in many ways as it's legal to use life insurance. So while I haven't seen it used that way, certainly it could be. Let me throw out an idea or two of the idea that if you started to spend your own life insurance benefits down, even though you hadn't passed away, how could you use it in kind of a non-standard situation? I'll throw 2 out that I've seen talked about. For instance, let's say somebody had done the GUL 10-10-10 plan. They get to the point where maybe they could spend down some of their longevity rider and start spending their own death benefit, but they don't really need it. And so they think, well, should I use it or shouldn't I? Let's say they had a charity in their life that they really felt strongly about and thought, maybe we should tap into this and use this policy's proceeds as a gift to whatever. Let's say it's your church. All right. So, it's a 501c3, right? So, in effect, somebody could create an income tax deduction from a life insurance policy because they'd take the proceeds, and during the years when it's not taxable through the years of their basis, they actually could give it to their church and, in effect, create an income tax deduction for something that never had an income tax deduction. That's kind of an interesting twist. Now, obviously, when they got beyond their basis, they could do that, still give it away, and there would be the taxable income and then have an income tax deduction equal to the same amount, and in effect make no difference on their taxes for those years. So that's kind of an interesting way to apply the longevity rider. Here's another interesting way to apply it. What if an ILET was created, and because one of the spouses had passed away, maybe, so it's maybe grandma by herself that's being insured. You know, you're not using survivorship because there's only one person, let's say. So they use this contract, but they put the longevity rider on it anyway. Why might you want to do that? Well, what if the trust has the opportunity at age 85, when grandma turns 85, to start dispensing some of the proceeds, because you can spend down your life insurance policy 10% per year. So let's just go back to the $1 million because it's easy numbers for my brain. You got $1 million policy, it's in the ILET, grandma turns 85, guess what? The trust could start paying out $100,000 per year, especially during those first years where it's return of basis and there's not a taxable event. And the grandmother could actually get an opportunity to see her descendants, her children, grandchildren, you know, whatever, whoever the trust beneficiaries happen to be, enjoy the benefits of this life insurance proceeds compared to when ordinarily what would have to happen to fully fund the trust. Grandmother has to pass away, life insurance policy is paid to the trust, and then the trust starts to pay it out, right? Well, now someone buying it has the opportunity to actually see their loved ones enjoy the money. Isn't that an interesting idea? So there's a lot of different interesting ways that the longevity rider can be used. Certainly the 10-10-10 plan, you know, the takeaway is that in the 10-10-10 plan, the guy is spending it down before it's a full dollar for dollar spend down at age 85. The point is he has the right to do it if he wanted to. That same guy again, and that's what someone else had asked, was if he waited to age 85, he could get his $240,000 out of the contract, but have a whole lot more death benefit left over instead of spending down $580,000 of his death benefit. He would only have spent down $240 to receive the $240. So just different strokes. We put the 10-10-10 together like that for simplicity and just to show what's possible.
Hey, and Michael, Michelle, just as kind of to that question, we have been kind of kicking around, and this hadn't made it, I guess, through or to compliance, but actually using the 10-10-10 in a business kind of setup where the business owns the policy. They do a 10-pay for a key employee. The employee, of course, beneficiaries will receive the death benefit, but in that in the third 10-year period, the business actually, you have an employee that's going to retire in 20 years. So in that third 10-year period, the business will receive the premiums that they paid for that employee back over, of course, over a 10-year period, and the employee's beneficiaries are still left with the death benefit. So still trying to, I guess, kick that around and work out the details on that, but we may come out with a piece that kind of speaks to a business kind of setup using the 10-10-10 plan.
Oh, perfect.
Yep, great idea. Works nicely that way too. We're still scratching the surface on all the interesting things that the lifestyle income solution or the longevity rider can do, because it can be used in so many different ways, right?
Sure.
Any more questions, ladies?
Let me see here. Got one more here. Again, with the 10-10-10 plan, what about using a lump sum or single premium in a plan like this?
Good question. Good question. I should have brought that up because people often do ask. The way that the contract is put together, although you can purchase a GUL contract with a single pay, generally you're going to make it a mech. And the problem is in the 10-10-10 plan, the software will not allow you to create a mech, because in that instance, then you're going to have first in, first out. The bottom line is the company took a position on and decided they don't want to do that. So if you had a scenario where someone had the money and just wants to pay for it, what certainly can be done is to put the lump sum into almost like a side account, but using a fixed period immediate annuity and pay it out over time, and that pays the premium stream. Because again, if it's too short of a period of time, like if you tried to do a single pay or a 3-pay or a 5-pay, it's just too short, and therefore it creates mechs. And the rest of the story is that when you're pulling the funds out of the death benefit, because that's actually technically a withdrawal of the death benefit, then what's happening is there's guideline recalculations, and you end up with guideline recalcs also, and then that blows the policy up too. So that's, if you wanted to try to do a single pay, you have to use some instrument like a fixed period annuity to pay it into the contract, and then it can be done that way.
Okay.
Bryant, would you add anything on that?
No, I think the 10-pay is probably the shortest amount of time. I've seen some scenarios where we can go down maybe to a 5-pay, but that is very rare. So generally it's a 10-pay is what we go with.
Excellent. Well, that's all I have from my side. Michelle, Kathy, if you guys have any more questions, we'll be happy to entertain.
That's all the questions I'm showing as of right now.
Okay, excellent. Well, what I would just finish off here, if I may, is that I will put up one other slide here. All these materials and information are available on our master playbook. If you just put up masterplaybook.com, AIG.com/master playbook. You can pull up the master playbook. It has all this material out there, and it's not behind a firewall, so it's easy to access. And the presentation's out here. The pieces are out here. The piece looks like the following. Here it is. There's a piece for, do you want income guarantees or both, for Grant with the 2-policy idea. Here's the 10-10-10 piece. Nice little piece that can be used. Again, it's about simplicity. It doesn't go into all the details, therefore keeps it high level. You can personalize it even and put your name right in there. So if you're interested in that, again, AIG.com/master playbook. And when you pull up the master playbook, it will look like this right here. And again, all that information is available to anyone, whether you're contracted with us yet or not.
Perfect.
I appreciate everyone's time today. And Melissa, thanks for helping us out and hosting. And we appreciate the opportunity to tell our story.
Well, yes, thank you guys for doing this for us. We really appreciate it. For all the agents on the line, this webinar is being recorded. As soon as we get the recording back, we can get this sent over to you. And if you have any other questions, feel free to contact us at 800-365-8208 and ask for your life marketer.
Thanks, everyone. Thanks for the opportunity to tell our story. Everyone have a great day.